By the way, the Bank of International Settlements and the Financial Times are both tying. So the BIS said gold and silver, precious metals, are a bubble, and associated it to the stock market. I'm going to say they're completely different things. The stock market is in hypervaluation by most measures, but that's because debased fiat needs a place to hide, and some of it has gone into the stock market. It is overvalued by many, many measures. Well, I want to report that, despite my advancing years, Elijah, my lifting power has gone from $5,000 shoulder press in a matter of weeks to $6,000. So I'm sure I'm getting stronger, or something is moving. Something is moving with great vigor, and it's making me smile. Unfortunately, it's associated with quite negative things generally for the currency, which I'm sure we'll be dipping in to now. But the first thing we have to say is happy silver bullet train ride day. It is absolutely ripping. I think last time we checked, we're approaching 64 on the cash markets. I think you may even have got higher on the future markets. The big thing I would choose to talk to, I mean, the question I always ask myself if being brought onto a show is, what can I say that most people won't refer to or might not say that adds value for someone who's already a participant? I'm imagining your audience who's watching us that has seen how we've been warning that this is coming, and I've mentioned a couple of times I'm the biggest silver bull out there. There are many people that are saying you should already be pivoting into oil or oil stocks and various other things, and I'm the guy who said, listen, you married Giselle Bundchen, you stop looking over the fence at those other ladies. You've won the lottery. And in that sense, without looking to poke Tom Brady in the eye or anyone else, you're in the best monetary assets right now for what is a fiat debasement cycle, for which the only capital preservation is a monetary asset that holds value regardless of the economic environment, which means in an environment where we're in the convexity down phase, suddenly very quickly, Ernest Hemingway's bankruptcy curve, as I like to call it, slowly at first and suddenly very quickly, you are at that suddenly very quickly. And I think on your show, I was warning that we're in the slippery slope side, and I had that little diagram where it's kind of like a paying off a mortgage curve. And we're in the suddenly very quickly phase. And these are your monetary metals. And this particular one over gold has got a specific supply constraint added into it, which is, verging on real problems on above ground supply. So it has an accelerant. And if I can add one last point to all of this, we are talking, you and I, the day after the Federal Reserve cut interest rates in an environment where the average since 2020, the average inflation over the last 5 years has been 4%. You're very close to 3% currently, and you got a rate cut into that environment with also not QE liquidity provisions being announced for the banking system where there is repo market stress already in. So cutting rates in a fiat debasement gain, there is no sweeter spot for the likes of silver ounces and gold ounces, it has to be said, but particularly silver. So my value add point is the gold-silver ratio. When do you get a pause, potentially, because this is a ripper at the moment? When are you likely to get a pause? So if I may, Elijah, and I hand back to you, but I would like to take you to the gold-silver ratio chart, but let you have a chance to come back at me after that answer.
The Federal Reserve's recent decision to cut interest rates, despite inflation still hovering around 3%, has sent a powerful signal. Liquidity is flowing back into the system through expanded banking sector support, mirroring the early stages of quantitative easing without using the name. Historically, rate cuts during elevated inflation weaken fiat currencies and drive capital into metals that cannot be printed. Silver gains most dramatically in this environment, amplified by a tightening supply chain and shrinking above-ground inventories. As pressure intensifies, the market is entering what many analysts call the convexity phase, where slow changes suddenly accelerate into rapid, disorderly moves.
to jump into that solid statement that you made and concur, we are most certainly in what I'd call disorderly descent phase of the gold silver ratio, and we'd drawn we typically put it in a pink box, the fact that for quite an extended period we'd been range bound on the gold silver ratio, and we weren't going to be getting what we wanted until we really let go of that range. And we determined it very much along the lines of a 72 stroke 75 to 95. It was kind of a 20 silver ounces to a gold ounce range. And the midpoint we had at about 84. And the big key move here is that you've really broken the box. We even had this fake break out here, and that got knocked back in. And since then, it's been very hard down. And the level I want to bring to everybody's attention here is the 65. I think we're going to have a 65 run. We're still in that, we're on a 3 weekly, a bit of an odd time frame. You can look at it fortnightly as well, or even monthly. I just wanted to see the separation in the candles, so I ended up on a rather bizarre time frame here, but it doesn't matter. The data is the same. We are approaching a level that's very important. The absolute low here was 62, so that dot there is 62. This was around 64. Now, these are all key seminal moments. We are talking about economically seminal, let me try to get that word out, seminal moments. Down here, you'll see was just mid-2016, early mid-2016. That was the Shanghai Accord China crisis, when China's property market first started to be exposed for the massive amount of borrowing that they created to keep heat in the economy after the 2008 crash. So we had, during 2008, a very dead West, and China was everything. And Australia skipped through the GFC far more smoothly than the rest of the world on account of selling commodities to China. You might remember that. And then suddenly China did the subprime crash of its own, but the whole world got around it, and that was a key event. That's when we dipped down on the gold-silver ratio. We started to have the uptick from gold. It was around 1,064 low at that point. It was a localized low. People forget this. And as it was on gold-silver ratio. So that 65 is very interesting. You ran 64 there. Then, of course, 2021 highs for gold and silver. That was a good surge. That was, again, at the point here. So this is a very important level. Generally, it's a very important level. So we are coming, and I expect us to breach 65. But my warning for people, particularly people that might be utilizing a bit of leverage and might have an account that's absolutely singing right now, great, congratulations, but be careful. What I suspect is going to happen is you'll probably run, certainly I would imagine that low, the 65 itself, which is the red line. And then I imagine you could even run this low, which dropped to 62. But at some point you might get a bounce, which I'd call a continuation pattern. It might be a flag. It could be instead a rising wedge. But in the long run, or let me draw that more neatly, sorry for the sketchy line, let's do straight lines so it looks better. You could get a little bounce of a rising wedge. So the only people who are going to get hurt in this are people that are chasing the top. So after it runs 65, it would be a bad time to go whaling in with disproportionate size. And that's more of the kind of a mistake a newbie or an intermediate might make, that if you're trading with leverage. So there's a possibility. That doesn't mean there has to be. At all. This might be so disorderly bad that the spill just continues and it's just a complete runaway. It depends what news flow you get. Key levels can be run. I'm just saying the possibility is higher that you get some form of reversal just after the 65 to the 62 period, which is the low here.
One of the clearest indicators of silver's explosive potential is the dramatic collapse of the gold-silver ratio. After years of trading within a predictable range, the ratio has breached key support levels, falling with unusual speed. Historically, sharp declines in this ratio occur only during moments of major economic stress or monetary realignment. The next significant threshold rests near 65, a level linked to past turning points, including the 2016 China credit scare and the 2021 metals surge. While the move may overshoot towards 62 or lower, temporary rebounds are likely. These pauses rarely last long, but they often shake out overly aggressive traders.
My suspicion of most likely is you make a slightly lower low than here, and you have some small, I don't think it's going to be significant. Does this affect a stacker? Not particularly. Just buy on the rally, you might get a tiny pullback if you've got new cash for investing in silver. Overall, the next level for us, generally for me, is you're going to meet 32, and you will then be at this zone here. Why is 32 significant? These numbers, I'm throwing out 65 and 32. We spoke on your channel before about the possibility of this being a head and shoulder. So that's the Shanghai Accord there. This was the blow-off high in the gold-silver ratio. When we broke out here, we incorrectly, so we must own where we thought, listen, if we have a demand-destroying event, it's possible that you could break higher when you broke higher, and that you could go higher on the gold-silver ratio before you got the down move, because this shoulder has now got quite big. But it turned down almost as we said it and started to reverse violently. So we're still in the possibility of a messy, I'm not going to tell you this is a textbook head and shoulder. Some imperfect patterns work brilliantly. Some ideal, almost diagrammatic ones fail. So you don't have this perfect beauty in a pattern that always guarantees you an outcome, and a messier one not to. But the move here is very, very violent. And the target from that head and shoulder, so why the 32, you'll see these projections come from the high down to that same 65 neckline. So we are projecting, and interestingly, it gives a low of 32. And then when you revert back to the 2011 high, so remember, targets are typically, again, where you might get continuation. So I'm just trying to warn people at what values of gold-silver ratio might you get slight pullback periods. The running of the 65 to the 62, possibly, and then here again. And the interesting part about this, let's just say they're both rising wedges that, that rally before falling. I don't think they'll be necessarily huge or vast, but that run will also bring you back to the valuations we met in gold and silver at the last bull high of 2011, which was 1,927 gold. And don't forget, silver was almost $50 then. It made 49 in 2011. And on some exchanges, you may have even had a technical trade at 50. So gold is a lot higher now. It's 4,200. So you can only imagine what silver will be down here at those levels. You can do the math. So a trajectory for the gold-silver ratio might look something like that, and then up, and then further down. Now, I've shown up on your show many times as my justification for being the single largest bull on silver there is, despite others saying, you really should be looking at, as I've mentioned, going to oil and others. This chart on the gold-silver ratio has come from much lower lows. We've previously had 15 as standard levels for lengthy periods, sometimes even single digits, tens, etc. And it's part of the financialization of everything era of way back that came in kind of post-Volcker and everything, that we'd had such high numbers for the gold-silver ratio. So we've also speculated that if you get to the 32 level, so I'm now building narrative on top of narrative. There's quite a bit of ifs and points of failure in here, but assuming we get there, so we have our bounce here, we rally, we come here, we have some form of continuation. You will then have a far larger, and this is, you sometimes get this nestling effect of head and shoulders. You'll have a far larger, this will all be a head. You'll potentially have a shoulder rally here at the 32. And then we are in another reversal structure, which, if done, takes you to a measured 8.22. That's a single digit. So I've shown up and said the overreaction of markets will potentially see you at a single digit gold-silver ratio, and at a point where gold will be a lot higher. So in terms of scenario casting, I've taken you a bit far into the future here. You shouldn't be counting too many chickens before they hatch, but this is the big guide plan of how things really get insane for valuation for this metal over here. Let me hand back to you.
If current momentum continues, the chart structure suggests silver may be heading toward levels few considered realistic even a year ago. Analysts tracking long-term patterns point to potential milestones near 32 and, if broader reversal structures complete, much lower ratios that once defined earlier eras of monetary stability. In such scenarios, gold's rising valuation becomes a launchpad for silver's outperformance. Though markets rarely move in straight lines, overshoots, fakeouts, and retests are common features of disorderly transitions. These technical dynamics don't concern long-term holders, but leveraged traders face heightened risk. Understanding these inflection points is essential for navigating the coming volatility.
So I expect silver's going to continue until we've its upside in terms of the move that we're seeing on the gold-silver ratio here. So until we've got through the 65 and probably even tested the previous low, which could mean we technically run it. So somewhere there between 50, what was that low? I think I said 62. Let's just double check it. The low on the gold silver rate, 62. And I think you can still run the technical level. There's a habit of, call it the stop loss being run. Not many people trade the gold silver ratio, but typically levels just get run as well to test the load. So once they're in that kind of momentum, there's a tendency to overshoot. So we are going further up short term. I'm not closing my leverage longs. I just don't think it's anymore the best entry point. You would have to go exceedingly small with very deep stops on the basis that you might get some more upside, but then there could be degrees of pullback of some scale that could occur. But I do also want to highlight some other anecdotes, which is not technical, and that is that we've seeing on the call, or the number of people are commentating that the calls at the 80 and 85 strikes for February delivery are contracts. So that's not very far out. That's 2.5 months, 2 months, between 2 and 2.5 months. I'm not exactly sure when in February either. I would need to check that for the futures. The next delivery date. Maybe someone can put that in the comments for us below, so everyone gets the heads up. But you're around 2 months at most, 2.5 months, and they're buying calls with an 80 and 85 strike. The volume on that has gone up immensely, which is really interesting for us, because in our more traditional silver setup, we've called for, so let's show the actual silver chart. It's almost remiss of us that it's taken this long in the interview to get to that point, that in our viewpoint, we are making the footsteps. We have an interim level target on our HVF method, that's 91. Now, were that to happen, those 80 and 85 calls would be in the money. So people have been buying whilst in the 50s, where really short term, I would say, possibly with no more than 2 months, 3 months in them, and aggressively with very far out of the money calls on the silver market at the value of the strikes of 80 and 85. And when you see volume, forgive me for mentioning 9/11, but I refer to the airlines being shorted. It's often there's some news or information, people with confidence. You know, when people are backing something with big money, it's usually wealthy people who are well informed or potentially even insiders. So, you know, make of it what you will, but I find that an interesting anecdote on the fundamental side. Going back to the technical opinions, which is our forte. So here's that silver chart that we were promising to show you. And as I say, apologies for taking so long into the chat to actually get it up, because it is the main event. We've got a 333 target. You can see it pointing to that over there. You are in between the interim levels We had an interim at 40. You had a pause and a pullback, and we expect it to rip to the next level. So you go from, these are our levels, interim level 1, interim level 2, and then full target. At each of these levels, there's typically a pullback and a bit of churn and some time elapses. Can't answer how much, but in between that, it's like a horse and fences. It gets a full gallop to make a jump. And this is a level. So you tend to lose a bit of speed just before, maybe struggle, have a pause. And this is in and around 91. So I do think, if we do bounce at 65, I don't think it's going to be the most, lengthy and protracted. And it is possible for us to spill right through. So we'll see potentially 91 run here at this interim, and you overshoot normally, which could technically mean you might get a touch at a 3-digit and then rejection. So there's such a big round number that's never been traded, of course, as we're making all-time highs now for the first time in silver. There's such a big number at 100 waiting there. So it's tempting to think you might actually get that test. That's going to be headlines. By the way, the Bank of International Settlements and the Financial Times are both tying. So the BIS said gold and silver, precious metals, are a bubble, and associated it to the stock market. I'm going to say they're completely different things. The stock market is in hypervaluation by most measures, but that's because debased fiat needs a place to hide, and some of it has gone into the stock market. It is overvalued by many, many measures.
Recent trading activity hints at expectations far beyond conventional forecasts. Options volume for silver strikes at $80.85, just months away from expiration, has surged dramatically. Such aggressive positioning suggests well-informed participants anticipate not only continued strength, but the possibility of a historic breakout. Technical models project interim targets in the 90s and long-term structures as high as $333. Levels supported by structural shortages and a mining sector unable to expand supply quickly. Unlike oil or other commodities, silver production is heavily dependent on byproduct mining, leaving the market vulnerable to shocks. In a monetary crisis, this scarcity becomes magnified.
Gold and silver, in terms of their long-term, far bigger cycle, are not in a bubble. They are not things that tend to get in a bubble. The fiat and debt debasement is the bubble. And in actual fact, you are going to go a lot higher on a far grander cycle. This one's going to be the gift that keeps giving long after people can believe it's true. Because, just think of what I'm saying to you and have been saying for a very long time. $333 as a target. By the way, this pattern triggered. We had a squeeze within a squeeze. We call that a primer. Right there was our initial break at $25. That was the last time we were going to see 25, and then the main pattern broke at 30. You can see these green numbers, 30 and 25. Since then, you have been in an absolute rip, and you're going, to my opinion, for a 3-digit number. I think there's a chance. I'm not saying it will happen, and that's my 50 or more %, but some of those calls may in fact end up in money, which is going to be very good time for stackers if in the next 2 months you continue to pick off 6s, 7s, and then cross 8s, and you start to get to these targets. That would be a very, very interesting development. And then after we've hung about maybe at the 191 range, you'll go into, again, and this is where the bulk of your wealth is truly going to be met. Don't forget, I've log scaled this chart, Elijah. I just wanted for a second just put this so that people can appreciate the debasement in the dollar. You need to think of this as dollar debasement. That is what you stand to get after the 91. It's not the end of the move. Anything that happens and pauses here then is going to be a horse with open territory, hi-ho tonto, I'm tempted to say, with an open charge to there. And the open fields are covered at a gallop. That is my overall assessment. Here's why it's different. There is no peak oil. Oil is continually created under the Earth's crust. It's not rare, decomposed dinosaur bone juice. There is a real lack of silver-specific miners. A massive percentage of silver is anecdotal secondary supply that comes out of copper mines, gold mines, iron ore mines, other product mines. In actual fact, there is a shortage, plus the barriers to starting new mines from a permitting point of view in particularly the first world countries remain high and have to be rolled back. And bringing a mine to market is a 15, 20-year endeavor. So the supply ain't going to get fixed in a hurry. Totally different. And very few silver miners. We're very aggressively long certain miners as well, many of them US miners. This is going to turn them into absolute cash hemorrhaging machines. I can't be more bullish. I'm hoping I'm leaving the guys excited on the silver front. It is the silver lining to what is going to be a very sad Fiat debasement story, but it will outperform even the debasement itself as it outperforms gold. And I've spoken many times, people need gold ounces as their new basis of account for their wealth. And this is not only a smart investment, it's an investment for your family as part of a transgenerational important act that you do for your children. So again, let me hand back to you.
As the dollar undergoes another chapter of long-term debasement, silver stands positioned to benefit disproportionately. The metal's role has shifted from industrial component to essential store of value in a world drowning in debt. With new supply constrained and demand accelerating, silver may become one of the most explosive assets of the decade. For long-term investors, this is more than a speculative opportunity. It represents a hedge against systemic fragility and a means of preserving generational wealth. While volatility ahead is inevitable, the broader cycle favors silver's ascendance. The coming years may redefine its importance in the global financial system.